So I'll wait another couple of moments, or you feel comfortable to be told stories while you are enjoying the delicious food.
And it is delicious, by the way.
Yeah, it's delicious.
Thank you.
It's really good.
And your name?
Tina.
Tina.
Yeah, my name is Nolene.
Nolene. Penny, Nicoletta, Tatiana, Tiberio, Adi, Monica, Adrian.
And
Hi
Roy.
Karen, I am doing a seminar. I am at work and I am doing a seminar. Okay, we'll talk after I am finishing, and Tiberio and Tatiana are passing their regards to you. Yes, okay, bye. Sorry about that, that was my daughter. An important person. Adrian and Doina. So, good evening. Thank you so much for coming in this terrible weather. I hope you will find our information session good and worthwhile your time and effort. My name is Monica Weissman, and I have been in this industry for about 15 years. My real profession originally is engineering. Some of the people around this table are from the same country where I am from, which is Romania. And I have a master's degree in electronics engineering, and I have switched careers about 15 years ago. Reason being that I couldn't find a good advisor. And when I was sitting at a table like you, being a client, I was looking for somebody who knew the products very, very well, somebody who would be proactive and tell me what to do and when to do, and somebody who would care about me more than about the sound of the money in their pocket. And apparently that was a tall order, so I had no other choice than to become an advisor. That happened 15 years ago. I mean, I never looked back. I'm very happy to do what I do because I help people achieve their dreams. And this is a very rewarding activity. I will never forget the thanks that I get from some of my clients. For example, I have a client who says she would never have a house if it were not for me helping her build her RRSP and be able to achieve that. This evening we will talk about some accounts or some types of investments and plans that you can take advantage of. And I hope that you will find the information relevant and convincing, and you will be able to use that right away. So without further ado, I will try to click my way through this presentation that I have built with the sweat of my brow. First and foremost, I have to tell you that everything I am going to tell you are my opinions, and nobody can hold my company, Manulife Securities, accountable for anything of the things that I am telling you. You should not use this as advice. You should talk to a professional financial advisor. I am one of them, but there is no one size fits all is a myth. Doesn't really work this way. Therefore, you should check your personal circumstances with a professional before you use them. We'll talk about what are the sources of income in retirement. We will talk about RRSP and TFSA, what are the differences between the two programs, which one is best for you personally, which one should have priority. We will talk about the planning strategies and about the value of advice. And having said that, let's start with the sources of income in retirement. And I am going to ask you to tell me what are the sources of income in retirement. Who knows one source of income in retirement? Yes, Tina.
Pension?
Company pension, absolutely.
Canada pension.
Canada pension, absolutely.
OAS, if you're ready.
OAS, if you're ready.
Me to say something? Maybe RRSP, but I don't know too much about it.
RRSP, absolutely. Tatiana?
Savings, investments,
Exactly.
kids.
Kids is a source of income or expense.
It goes.
I am not so sure.
Major source.
Sorry, Monica. What means the QPP?
QPP is a Quebec pension plan.
Okay.
So not everybody qualifies for this, is not a universal benefit, the Canada pension plan?
Canada pension plan, if you not working for a company which has the obligation to you to do CPP, you don't get CPP. Some private companies maybe don't.
Yeah.
Or if you are self-employed.
But you're forced to contribute to CPP, no?
I am not sure
I
if you are
remember,
forced.
because I'm self-employed, so I remember that.
Maybe you are forced, but maybe if you don't work, you don't. You don't have CPP. A homemaker don't have CPP. They still grow old.
Well, if you're out of the workforce for a long period of time, your amount of CPP will be minimal.
The amount of CPP also will differ.
Mhm.
This will give you, I wanted to do that one by one, but in principle, you can
Like you
work.
collect all of that in that column if you're employed between 60 and 64.
Mhm.
Is that what you're
No,
saying?
Yes.
Or no?
CPP
Even
if
after.
you're
No,
working.
Even after, because the rules have changed since 2009 to today, and if we were to do this today, I'm sure that this line would be with much bigger numbers here and here than they have,
And still collect their investment
and
their
still collect the rest. Yes. And the reason is that first of all, the social benefits are good but not enough. I think they were designed initially, whenever they were designed, and I don't know exactly the time when that happened, they were designed maybe with the idea of covering half of the needs in retirement, but today they will not cover even a quarter of the needs in retirement.
depending of if the oil goes up or down, basically.
That would impact, yes.
I was a little confused and still am then, because initially when you presented, you said the first row,
Yes.
it's 7% of people in 60-64 collect the income.
Yes.
Now if you show us the whole table, it looks like in the age group 60-64,
Yes.
7%, it's 7% of the 100% income,
Yes.
which collects 64, so
Yes, so
what I'm...
in this age group, most of the people still work.
52%.
The main income that they have in this age group
It's
is still
employment,
from
yeah.
employment, right?
Yeah,
But they do collect, some of them do collect CPP,
qualified for it. or
and
whatever.
some of them are already using their RRSP,
Mhm.
and some of them have other sources.
But it's not sum, because the sum of that ends up to 100%,
Yes,
which
all
is
of them.
the income.
This is an average image,
Yeah, but the average 60-64, as I read it, is that collect of 100%, which is his income, 7% comes from CPP,
Yeah.
21 from RRSP,
Yes,
investment trends 12%,
Yes,
employment, that's an average
yes,
that every person in that age group.
yes, yes,
Okay.
that's correct.
Yes,
Because the CPP, it's, you can start collecting at 60,
early.
Yes.
but you're going to be penalized.
Right, right.
So that's why the percentage is so low. I mean,
That's
I
right.
started collecting at 63.
Yes, and then you got penalized less than those who start at
Less,
60
and,
because the rule of the CPP is the baseline is 65.
Mhm.
So if you get your CPP at 65, you get whatever is supposed to
Maximum.
happen.
Yeah.
Yes, not the maximum.
Not the maximum.
You
The
get whatever is supposed to use yours.
Mhm.
If you start the CPP at age 60, for each year that
You
you
get
take
that.
it before age 65, once upon a time you were penalized 5%. Today they changed the rule, and if you do that today and you are 60, they penalize you 7% per year. So if your CPP was supposed to be $1,000, let's say, at age 65, and you take it at age 60, you were penalized 35%
Over the 5 years.
Mhm.
for the 5 years, and today you would be penalized 30% before and 35% now. So you would start at 650 instead of 1,000, and you would stay at 650 forever. It never changes back up as you grow old. You just freeze it at that value. Yes.
Question, is it 65 or 67?
No, 65.
But you can
65.
continue to contribute to it if you're working,
You-
if you want.
Yeah, they changed the rule and there is
Yeah,
something
yeah.
else. You can continue to contribute until the age 70. And they call this post-retirement pension,
Yes.
blah, blah, and they do a calculation which is separate. And the formulas are quite complicated for something which is very simple, but why make it simple if it can be complicated? So you need to work with a professional if you want to really calculate this exactly how it is. But in principle, if you take the CPP, you have an eligibility not to contribute anymore.
You have a choice.
Pardon?
You have a choice.
You have a choice. You have a choice. You can say, this is it, I am done, I'm not contributing anymore. Or if you want, you can continue and contribute until the age 70. At age 70, they stop you. And
I should live till 70, but
okay, so
you never know.
this is a quiz. We want to check how well do you know these programs. So, when can you convert an RRSP to a RIF?
71.
What is it?
RIF, so RRSP stands for Registered Retirement Savings Plan. That's where the RRSP comes. Registered Retirement Savings Plan. RIF is Registered Retirement Income Fund. And there is a conversion which is mandatory at a certain age. In a moment we'll talk at what age, in which you have to change the name of your plan from RRSP to RRIF. And the main difference between the two is that when you have an RRIF, there is a mandatory amount of money that you have to take out from that investment plan in order to support yourself. That's the design idea of the RIF. So my question to you is, when can you convert the RRSP to a RIF? At what age? Who is brave enough?
75. No, the next one is 71.
Adrian says 70.
65.
65.
When you can or when you have
When
to?
you can.
When can you?
I think at any time, 65.
I think I heard the right.
No?
Anytime or 65?
71. It's 71.
71.
That's when you have
71.
65.
That's not,
That's when you have to. If
You
you're
can
buying
convert
when
it
you
at
have
any
any
age.
time.
Yeah, it's your money, you
Ah.
can take it anytime, yeah, that's what I thought.
Any
Or
age you
you
can
can do it at
convert
any
it.
time.
If you want to convert it, you are 35 years old, you've built an RRSP,
Pay
you
taxes
have
on it.
$50,000 in it, you want to convert it into a RIF and start getting money from it every month or every year or whichever way you want, you can do it. Okay?
But there's,
Oh,
but you have
So
to
the
do it
question
at
was,
17.
when are you mandated to do it?
That's the next question.
Yeah, mandatory.
When do you have to convert an RRSP to a RIF? At what age?
71.
71, 71, 71,
71.
71,
At the
I
end
think-
of 70.
at the end of
I
70,
think it's 71.
71.
71.
Yeah.
It's the year when you turn 71 that you have to convert it. By the end of the year that you
Now, what
turn
is the difference of the
71.
two funds?
Sorry,
What's the
Tina?
difference of the two funds?
Of the two funds,
Yeah.
it's two types of accounts. The main difference that you have to remember is in RRSP, you put your money, you invest your money, you grow it. In RIF, you have to start taking a minimum amount every year. The government mandates this from a RIF account. And I will tell you in a bit, when we'll talk more in detail, how they calculate this, but the amount depends heavily on how old you are. So up until the age of 72, 71 or 72, the amount that you can take, that you have to take, is relatively very small. It's 3-4% per year. So if you have $100,000 and you have to take 4%, it's $4,000 per year. So because the idea of the design of these plans was to provide you with a tool which allows you to save and build and grow a nest egg for retirement purposes. So the interest of the design, the objective was not to allow taking money and not to force you take money out before you have started being in your 70s. Make sense? Questions?
What will happen with the money?
Pay taxes.
Okay.
No, the money
What is
left
a tax advantage, which is most frequently forgotten by people who are over 65, but who have an RRSP and did not yet convert the RRSP to a RIF?
Because the RIF is taxable income. You have to pay tax on it.
Yes,
That would be one reason once you convert.
but I am talking about a tax
Oh, the
advantage
tax advantage of not taking it.
which is not used because people don't know about it or forget about it,
So to not
and which can be used before converting.
So what is the advantage to not converting it?
No, you have an RRSP
Right.
and you are 67,
Right.
okay? And you say, I don't yet need this mandatory money, so I want to still continue to grow my RRSP, so I'm not converting it into a RIF. But there is a tax advantage that you can use, even if you didn't convert to a RIF. What is it, the tax advantage? Yes.
Paying tax at a lower amount if you're taking it out.
Close but no cigar. No? Anybody? Okay. You can get $2,000 tax-free.
Wow.
If you are over 65 and you have an RRSP, no RIF. You are allowed to create a RIF which is just for the purpose of taking this $2,000 out.
So,
And is that 2,000
30
tax free?
so,
It's tax-free after you do your taxes. So they
So you
will,
do have to pay tax on, and then you.
and then you reconcile, yes.
so Monica, to
Yes.
understand, you could take $2,000 from your RRSP
Yes,
and put in toward a RIF,
Yes.
and that will not be, it's tax-free.
It's not tax-free, it's
a-
taxable, but so they will send it to you, this
Okay.
$2,000, they will take at source 10%, so they will send you 1,800, but when you reconcile, it will become practically tax-free.
Okay, but if I open a RIF,
Yes.
then I'm not, it isn't mandatory to take out some money?
Yes, but you can have an RRSP. Let's say you have an RRSP, and let's say you have $100,000 in the RRSP,
Okay,
and you are 66 and you want to use this.
yes,
You open a RIF,
yes,
and you transfer from the RRSP to the RIF only $2,000.
yes,
These $2,000, you can take them out in that year,
okay,
and practically when you reconcile, it will be $2,000 tax-free.
okay, and,
Okay, so you can take out $2,000 from your RRSP via the RIF
if I
tax-free.
want to keep them in RIF, is not,
Not a
possible.
problem, no.
Oh, it's possible to,
Oh, yeah,
to keep
absolutely.
it
And
over there.
do the same thing next year.
Because I understood when, once you have a RIF, you are obliged.
Yes, but if you have nothing in it,
No,
I mean,
I put those 2,000. I have
those 2,000 you put, we send it to the bank because you want it this year, and then the RIF stays there and waits for another 2,000 next year.
Okay, so I cannot. add
Yes.
the-
Sorry, just so that I understand, so if you put into the RIF, is the tax on that RIF more favorable than taking out 2,000 of your RSP? Like, what is
It's the
difference?
same.
It's the same.
It's
So-
not more favorable, but if you take it from the RIF, when the reconciliation is done, it's considered RIF income and it becomes tax-free. If you take it from the RRSP, then it's considered the withdrawal from the RRSP, it's taxed as
So
normal
you have to be
income.
66 for that.
65 plus,
65.
over 65.
Interesting.
But is there withholding tax on that?
There will be a withholding tax of 10%, which will, when you do the reconciliation, when you file your tax return, will be returned to you.
Because there's a different tax applicable to the
It
withdrawal and
it
this.
should be free. It is free, but the free becomes free only when you reconcile your tax return, not when they send the money.
Yeah. Okay, thank you.
Okay? So, who can contribute to a TFSA? TFSA stands for Tax-Free Savings Account.
Anybody.
Anybody?
Anyone?
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 Anyone who?
Is 18, Canadian citizen.
Resident.
Exactly. Anyone who is over 18
Over 18.
and is a Canadian
Yeah, I mean, you have to-
resident,
You don't have to be.
not citizen, resident. Canada is giving the benefits based on residency. US is giving the benefits based on citizenship. Okay? So anybody older than 18 resident of Canada. What is the limit contribution for RRSP this year?
Percent of your
Depends
income.
on your tax.
5,500.
50, no, for RRSP.
For RRSP.
For RRSP.
It depends on your income and how much of your income is paid towards your own pension in your job.
21,000.
Okay, but let's assume that there is no pension and we can put everything in RRSP. How much would that be?
Total amount,
And
anything.
there must be a maximum. Yeah.
I say, no, you can put in RRSP as much as they give you in that tax return.
And how do they calculate that amount?
I have no idea.
Tatiana?
It's an
Phoebe?
enormous amount
I
anyway.
thought it was some percentage of your income, up to 20% of your income, previous year's income on,
No, it's 18%.
or some
18% of your earned income
or
up
some
to a limit
arbitrary
of
something.
21,000, I think, or 18 or 21,000.
24,920.
be earning a lot of money.
24,
Okay.
remember,
So every
24,000?
year,
24,000?
roughly, you can put in 24,000 into your RSP.
No, depending on how much
Yeah.
money you earn. You can put 18% of your earned income up to this limit. After this limit, so if you make 300,000 earned income, 18% of this 300,000 would be much more than this, right? But you are limited, this is a maximum that they allow you to put. So even if you make 300,000, you still can put only 24,920.
But
Are
it should be
these
RRSP,
limits
they're not TFSA.
Pardon?
Are these limits changing?
Yes, every year, yes. They are changing. The rules have been issued about 5-6 years ago, I'm not sure, and they have some limits. So every year it goes up a little bit, yes. So 18%, let's say, for somebody who is making $100,000, is $18,000. That's quite a bit of money
From your earned income.
from your earned income.
Is this from your gross earned
No,
income?
earned.
Net.
From your earned
Does that
income,
include interest on investments? No.
No.
the earned income
Yes.
includes the taxes.
Right, so it's gross earned income.
Gross earned income, not earned income.
Yes.
I am not an accountant, so I
No,
cannot
yes,
tell you
we're
which
just,
line
it's an interesting
in the,
discussion.
yes.
No, that's fine. We're just,
That's not to me.
Now, what happens with the amount of money that you put in RRSP from the point of view of paying taxes?
It reduces your
taxable
It
income.
reduces your taxable income, that's right. So you make $100,000, you can put 18,000 in RRSP. If you do put 18,000 in RRSP, you will be taxed on 100,000 minus 18,000, which is 82,000,
Yeah.
right?
Yeah.
So you will be taxed less, you will pay less tax than if you were not putting money in RRSP.
And the other advantage, if you don't make that big amount of money, paying buying if you can afford to buy a decent RSP, it might put you in a lower tax bracket by the time.
Yeah, absolutely. When you reduce your earned income, you have a chance to reduce your marginal tax rate, which is the rate at which they charge the upper portion of your income. So let's take an example which is, I'm simplifying the numbers because I want you to be able to follow me in your mind. Let's say that if you make $100,000, your tax would be 50%, which is actually almost true today in Ontario. And if you make, let's say if you make $80,000, your tax will be 40%, okay? So if you make $100,000 and you put 18,000 in RRSP, you are taxed as you are 82,000 you made. So you are taxed at 40%, not at 50%. 40% will mean that you will pay, let's say, $32,000 in tax. 50% of 100,000 would have been $50,000 in tax. So the difference between the two is the tax savings, which is actually not a saving, it's a deferral of the tax, because you don't pay this tax when you earn the money. Eventually you will pay it down the road, because when you take money from RRSP, it will be taxed. When you take money from, when you convert the RRSP into a RIF and then take money from the RIF, it will be taxed. I made the temperature too high, so now let's make it.
So unless you have an RSP? So he says, these two things.
Does this start to make any sense?
Yeah.
Okay. what is the limit of contribution for TFSA in 2015? 5,500.
In 2010.
In 2015.
Now it's, but in 2010.
2010, 5,000. So now it's 5,500. Very good, excellent. What is the rule of withdrawal for TFSA? How do you calculate how much money you can take out at any point in time from your TFSA if you wish to do that?
There's no limit.
I think.
How
No
much you
limit.
have in the account?
Pardon?
How much you have in the account?
How much? That is true. But
I think you can't contribute then for the next year. You have to wait until the following tax year.
yeah, you can take any amount, anytime, as much as you have, Nicolette. You are right. Okay. What is the saved contribution room? How much are you allowed to put back in TFSA?
I think you can
The whole
reimburse that amount,
Yeah.
but you can't go the next
The
year.
amount.
Okay, it's a little bit more complicated than, it looks more complicated than it is. It's whatever you took out the year before, plus the contribution room that you had.
So do you?
So if you, let's say you have $36,500 in your TFSA. If you put money every year and if you don't make this money grow, that's how much you would have today. Yes.
So if let's say you only put in 4,000 one year, does next year you can put in the extra 1,500?
Yes. Yes, exactly.
Plus the 55?
Yes.
Yeah.
Exactly so. Exactly so. So
is it
if
true-
1 year, Nicoletta, if 1 year, what Penny said is, if 1 year you don't have 5,500, you were allowed to put 5,500. You didn't have the money, you put only 4,000. The next year you can put 1,500 that you missed the year before, plus the new year.
Oh.
Okay?
So if I didn't put anything until now.
You can put 36,500.
Going back to year 2010.
2009.
Oh, you can go back that far?
Yes.
Yeah. So
It's a carry forward forever of your contribution.
You have money.
If you have money, that's right.
From somewhere else. It's what-
So
Yes.
I have two questions, Monica. So if you take, just say you had 30,000, goes up until 2014, 30,000, and you took all of that out. you-
When?
So say in 2014,
Yes.
then I think you can only contribute the 2015 amount the next year. I don't think, can you put all that stuff back in?
Yes, you can.
1 year later, so
Yes.
you could take it all out in December and put
Yes.
35,000 in
Yes.
in January,
Yes.
is that right?
Yes.
And what happens?
But you cannot take it all out in January and put it back in December of the same year.
No, you have to wait in the next year.
You
And then-
have to be across a calendar year. That's how it works.
And the other question I had, so if you take it out, so you're not really taxed on it then? because
No,
just
you
have
never
a lump sum.
taxed on money.
So that's good.
From your TFSA, you are never, ever, ever taxed.
No.
Ever.
So why wouldn't people take the TFSA out rather than the RRSP?
Why wouldn't?
Why wouldn't people who have a
Save in
TFSA
TFSA.
and an RRSP?
Yes,
Why wouldn't they then take out the money out of the TFSA?
because they don't understand how it works.
But also, there is a tax implication when you take it out of your, if you don't take it out of your RRSP early enough, aren't you paying more as time?
We'll get to talk about that, Penny. We'll talk about that and about when there is a logic into melting down an RRSP, and it may be the circumstances, personal circumstances of some people, and how this can be done in a way which is optimal for the person. Okay? So, what is the rule of redeposit? It's what you withdraw last year plus whatever contribution you have carried forward. And what is your dream for retirement?
Whatever you draw last year plus whatever contribution. No, that's the same answer.
It is the same answer because it is just the same question.
What is the
Otherwise,
rule of redeposit to TFSA? And the answer
Of
is
putting money
whatever
back.
you withdraw last year, plus whatever contribution. And the next question is, what is your dream for retirement?
Yes.
The answer is the same, whatever you
No,
withdraw
no, the
last
answer
year.
is only you can know.
You can know.
It's a little bit, it goes like this.
It's just off a bit.
Yeah, I know, but it's the same answer, the two of those.
Yeah.
Yes, these two are actually the same question, right?
Yeah. Oh, that's good. Yeah. No, that was great. That was a great presentation, Mom.
Good.
Yeah. It was
Okay.
very explicit.
Okay, so now you know a little bit about the rules around the RRSP, the TFSA, and the RIF. And feel free to stop me at any point in time with any questions. Now, we will talk about the strengths, weaknesses, opportunity, and threats
That's interesting.
for RRSP and RIFs, right? Yes,
Sorry.
go ahead.
If you take money out of TFSA
Yes,
and you never put them back,
yes,
let's suppose,
yes,
okay?
yes.
Would you be penalized?
No,
No.
It's your savings.
it's your
Saving.
It's your privilege to do whatever you want. The money, the main difference, what is the main difference between the money that you put in RRSP and the money that you put in TFSA? What is the main difference between the money that you put in TFSA and the money that you put in RRSP?
When you take
Tax.
out from RRSP,
No,
how to
no,
pay?
we're talking about money that you put in.
The difference between
What is the main difference?
Tax savings.
one is
Tax
invested, one is not invested, I presume.
You can invest that.
What exactly do you mean, Adrian, by tax savings?
Well, when you deposit the money, you put them in a RRSP,
Yes.
you save the money from the tax, you pay less tax.
Yes.
You deduct the
And then-
taxable
When
income.
you take
And then you take them out.
No, I am only talking about deposit.
Yeah.
Yes?
the TFSA is a tax-free investment, whereas the RSP is tax deferred, so it reduces your taxable income.
In both accounts, in both plans, in both accounts, the money grows tax-free.
That's right.
That's the same thing for both accounts. So what is the main difference? Yes, TV?
The difference is on the RRSP, when you have $100,000 a year taxable income, you put 20,000 in RRSP, your income becomes 80.
Yes.
In TFSA, if you make 100,000 and you contribute 20 to the TFSA, let's say, your income taxable is still 100.
Okay, that's exactly the difference, but I want it expressed a little different, and I will tell you.
Go ahead.
The money that you put in RRSP is before tax money. Before tax, because you deduct it from your taxable income, and you are not taxed on it until time when you take it out. The money that you put in TFSA is after tax money. It's money on which you already paid the tax. Therefore, when the money grows in TFSA tax-free, you take it out, it's never taxed because it was to begin with after tax money. Yes.
So I don't really understand that because if you're making, so say I'm making a contribution to an RRSP, I've already paid taxes on that money for
That's exactly what I'm saying. It's before tax money. Because you're not paying tax on that money.
But
But the money that you put in TFSA is money on which you already paid tax.
But why did I not already pay tax? I have $10,000 saved. I'd like to understand that.
Yes.
So I have $10,000 saved. So this came from savings. I pay my taxes on my income.
Yes.
And I put $5,000 to an RRSP.
Yes.
And I put $5,000 in TFSA. But I pay tax on both of those $5,000.
Hold on. What happens with the 5,000 that you put in RRSP? What happens with let's say you had
It
this,
reduces my taxable income, that's what you're
Yeah,
saying.
exactly, that's.
because it reduces your taxable income, it becomes before tax money, right?
Yeah, thank you.
So both plans are growing your money tax-free, but one of the plans is after tax money in the TFSA, and one of the plans is before tax money in the RRSP, which becomes RIF after that.
Yeah.
Okay? Everybody is clear?
So which
Yes.
one would be better to put in?
Good question, Tina. We'll talk about that.
Okay.
Okay? Now, what is a strength of the RRSP? What is the benefit that you get from using the RRSP?
Tax deferred.
Tax deferred,
Savings for your
savings
retirement.
for your retirement, yes. What else?
You could save for your house and put an,
You could save for your house. First of all, it grows tax-free, right?
Growth and income.
Yeah. You can save for your house. You can take up to $25,000 to buy your first house if you never had one, or to buy a house if you never had a real estate property in the last 5 years.
Oh, so you never had in 5 years?
If you have sold your house and rented for 5 years, and after that you decide you want to buy a house, you can use the $25,000 from RRSP
Yeah.
and use it as a loan for a house as if it was the first time. Yes?
Can you use it as a loan for a child's first house?
No.
No, but do you know when else you can use it for your schooling?
Thank you.
For what?
Life learning.
You can use it to pay tuition, to improve your skills, right?
Yourself or your spouse, I think.
Yeah, probably yes, and the amount is not exactly the same. It's $20,000. For the house, it's 25. The house, if you borrow from your RRSP for your house, you will have 16 years to pay it back.
Oh, sorry,
If you take the money for life learning, for tuition, you have 10 years to pay it back.
I don't come from New Zealand.
Okay.
excuse me, and if you don't pay them back?
If you don't pay them back, in principle, you have to pay 1/10 for this or 1/16 for the other one. If you don't pay it back, if you don't put in RRSP that amount, you will be taxed that year for the amount that you should have put back. What's another strength?
What's that?
There is a creditor protection for the money that you have in RRSP. If you declare bankruptcy and you have debts, this money in RRSP cannot be taken and used for paying your debts. It has a creditor protection feature, the RRSP money.
Great, that's good.
Okay? What are some weaknesses?
Yeah.
When you take the money out from the RRSP or from the RIF, doesn't matter from which one, you will pay tax on it.
Do you know, I'm just wondering, you might know, I mean, I don't know, you might know it offhand. Is there a preferred tax rate or anything applying to that? Not really, no.
It's always marginal tax rate.
Yeah, okay.
It's always depending on how much money you make in total. The use of money is not flexible enough, which means, yes, you can take money out of the RRSP for any purpose.
Yeah.
You want to go and have a trip, and you want to fund it with money from RRSP, nobody will stop you from doing that. But you cannot put it back. Okay, you lose the room of that amount of money that you take out. You
Yeah.
cannot put it back.
Wow,
The
that's an interesting
these are the
point.
rules
Yeah.
of the RRSP.
Yeah.
But how would they know that you're using the RSP money for that and not that?
No,
No,
they're
it's
the
the same thing.
strengths and weaknesses. It's the same RSP.
Well, I thought you said you can put it back in them.
No, you declare what you're going to use it for when you take it out. And they will not tax it if you took it out to
For
fund
those two.
a house or to fund tuition. Otherwise, they will tax your RRSP money that you take out, and the taxation goes as following. It's a taxation at source. If you take up to $5,000, they will tax 10%. So you will get in your hands $4,500 because $500 will be taken for tax. If you take $10,000, you will be taxed 20%. So you will get $8,000, $2,000 will be taken for tax. The tax will be recalculated once you do your tax return for that year. But at source, for $15,000, they will take 30%, or any amount bigger than that, they will take 30%.
Also, from my experience, the money that you took for home buying, you are supposed to put it back in your RSP, otherwise it's...
Yeah.
That's right.
Yeah. Otherwise, every year they will tax you as if you had 25,000 divided by 16 that you didn't put back in your RRSP. They will tax that amount as if it was income.
Can I just
Yes.
ask you, Monica, so if, you know how it's 10% if you take out $5,000
Yes.
withholding tax. So if you take out $4,999, do they not withhold anything?
They will withhold 499.99.
They'll still
10%. Any amount. That's why 200 for 2,000.
I see.
Right?
Yeah. Okay.
It's always
Yeah,
10%
that's
up to
right.
5,000, 20 between 5 and 10. Now, once upon a time, we were splitting 15,000 in 3 times 5,000.
Yes, that's
Right?
right. That's why. I was-
Now they don't allow that anymore. They will look how much you got this
take
year.
10%,
If
yeah.
you took 5,000 and you take another 5,000, the second one will be taxed at 20.
Yeah.
As if you took 10,000 in one
I
shot.
see, yeah. Yeah.
So it's,
Yeah,
it's
'cause I thought at
they,
one time-
they changed the rule, yes.
Okay.
Okay?
That's good, yeah.
Okay? Questions? Okay? The money that you lose in RRSP cannot be replaced. That you lose or you take out for any other purpose. But that you lose, I say lose because if you have an investment and it doesn't work out and you put $10,000 and now it's $6,000, too bad. That's what it is. Now, this is especially important, in my opinion, because people usually don't pay attention what's happening with their money in RRSP. They go to the bank, they give the RRSP to the bank, and then that's it. They have no time and no strength and maybe not much knowledge to look at what's happening. But the truth is that if you lose money, you cannot put it back. That's money that is lost forever. Instead of growing tax-free, it's lost. That's terrible. The other thing is, it may be growing, but maybe it's growing at 1% per year. Maybe the inflation is 3% per year, and in fact, it's not growing, it's shrinking from the purchase power point of view. Or it's growing by 5% per year, but it could have grown, the market went up 10% in the same year. Like, not good enough advice is hurting you. You will see in other slides I have here, what you don't know may hurt you and will hurt you eventually.
So why do banks not tell you this? I don't know.
Tina, this is such a good question. Let me tell you why. why I think. I think that people at the branches of the banks do, normal people are nice and they do the best they can. They're not trained, they're not paid. It doesn't matter if they do a good job or not, they get the same salary, right? You cannot force somebody to work well. This is, if I don't do a good job, my clients will go to the bank. If the bank doesn't do a good job, the clients of the bank very rarely will leave the bank to come to me. I have to go out and tell the clients that I can do for them much more and much better than the bank. And absolutely, because this is the way that I live, and the only way in which I can convince somebody to work with me is if I do a good job. The bank is the default go-to for people. I am not. So I have to earn the trust of my clients and the willingness to put their money with me. So it's a very good question. And partly, they are not trained. I mean, I am highly trained and I am training myself.
That's what I mean. Like if you go to a bank, if who knows nothing and I go to a bank and I say I want an RSP, they're going to say yeah, and I think they're telling me the best possible thing, I would assume, right?
Yeah, but it's not. The truth is not. You're not well served by the bank, and you go there today and you speak to somebody and tomorrow it's somebody else, right?
And some of them are not well trained.
No, that I understand, but I figured if that was like a done deal, like it was like a monopoly kind of, people go in and do it, and it's across the board, clearly not.
It's a tax-free growth, it facilitates savings for retirement. If it doesn't exist, if you don't have one, the golden age may not be so golden, right? Because the benefits, the social benefits that you get from the government, which are guaranteed, are not supposed to fund 100% of what you need in retirement. They are supposed to fund between 25 and 50%.
Can you tell us something about the clawback?
Yes, and thank you for the question, Tatiana. The OAS is old age security, which has been mandated, 50 or more years ago in Canada to be paid to the residents of Canada, provided that you have lived in Canada 40 years. If you have not lived in Canada 40 years, if you are a newcomer or an immigrant to Canada, as many of us are, then they will prorate the amount of money that you should get from the OAS by dividing the number of years that you lived in Canada by 40. So let's say I came to Canada in 1988. So I've been in Canada 26 years. This year it will be 27. They will pay me, if I ask for an OAS, they will pay me the let's say around $550 per month, times 26 over 40.
Plus?
Times, prorated.
I thought the total amount was 550.
550 is the maximum.
Oh, and then they're going to prorate it.
And then they prorate it with the number of years that you lived in Canada. So if you lived in Canada 40 years, you get the full amount of the old age security. If not, you get a smaller amount.
Now, does this get recalculated every year?
No. It's frozen at the amount that you started.
Okay.
In the year that you started. The other rule is, it is capped by your income. After your income, so the amount of income is changing every year. This year is approximately $76,000. So if your earned income is higher than $76,000, they start clawing it back. and they prorate the clawback in such a way that when you make $130,000, they claw it back fully. So it's 550 times 12. It's about $6,000 and change, and it's clawed back prorated when your amount of earned income grows over 76,000, fully clawed back at 130. Okay, so anybody who has less than 76,000 or up to 76,000 earned income can get the full OAS. Okay.
And I think that's
I heard that I'm not quite sure. So if I heard,
yes.
Okay, that there are countries that have
dual agreements, yes.
And even if you stayed less in Canada, if you worked back home and the country is under that program, you earn some years.
Yes, but it's
like
not
that.
paid by Canada. You can apply, and if there are agreements,
Yes.
then you can apply and get from the country where you lived and worked.
But those are not counted as years for the old age.
No.
For
No.
the OAS.
No.
They are not counted.
If it's counted for clawback, that's what you say?
Yeah.
I think it is. I think it is.
Mm-hmm.
I think it is. I don't know for sure. I would have to check. Yes.
I have a CPP question.
Yes.
Do you know if a person is a primary caregiver for children
Mm-hmm.
for any length of time? Are they something that
Yes.
they're allowed to do?
Okay. Thank you. Yes. So, in the calculation of the CPP, if somebody who is usually a woman has stayed home to bring up the children for a number of years, and therefore didn't earn money and didn't contribute to CPP those years, there is a formula, if you work with a professional, which allows to compensate for these years that the woman lost and increase the CPP, but you have to apply with proof of the time stayed home to take care of the children, and best is to work with a professional.
And that's irregardless of the spouse's income?
Irregardless of the spouse's income, it's for the individual CPP.
actually, my husband actually just applied for Canada Pension,
Mm-hmm.
and I called up Service Canada to ask them, should I, because we kind of basically raised the kids together. He was off sometimes, I was off, so I didn't really know who should claim that child or anything. So over a certain number of years, I don't know if they averaged it out, his income was lower than mine, so they told me that he was marginally better off to be the one to claim.
Mm-hmm.
So that's what we
Yes.
did. I'm not ready to apply yet, but
Yes.
he did apply and he put himself as
Yes,
the thing.
yes, and there
So it made a
is a
difference.
formula which
Yeah.
allows to raise
So,
the
because
limit.
It doesn't have to be a female.
No, I think it's just, yeah, if you're still living together, it can be
Yeah.
either party, yeah, so.
Okay? So, TFSA. First strength is that everything grows tax-free. Can you see, Donna?
Yes.
Another strength is the money can be used for anything. You can take some money, go get a trip, come back, make some money and put it back, right? We talked about how you can put it back. Another very important thing is the contribution that you put back is based on the amount that you withdraw, not on the amount that you invested. What that means is, let's say you put $10,000 in your TFSA. Let's say you had a good advisor and it grew to be 17,000. You take out $17,000, you can put back how much?
10,000.
17.
17.
Oh, you put it
Same
all
We
back.
put it all back.
All that you took out, you can put it all back. Not only how much you invested to make that 17.
So it must be the following tax year, not the
Yes,
one that you
yes.
took it out.
But
Okay.
it's the full amount
That's
that you
good.
withdraw, not the amount that you invested. Okay? So, in my opinion, TFSA is an extremely powerful tool that was gifted to us by the government and which is totally not underused and not understood.
It's only 5,500.
Yeah, 55
is sea money.
But since 2009 today, if you don't have a TFSA, you can put 36,500.
And if you save
3,600 in the bigger scheme of things. In an RRSP,
not 3,600, 36,000.
Yeah, even so.
Yes.
That's peanuts.
Why is it peanuts?
It's peanuts. You have to have six-figure numbers in your RRSP.
Yes, these peanuts in 5 years at 10% become 6 figure.
10%.
I don't understand.
This
it depends who, Tatiana, I know that you are skeptic and you have the right to be skeptic, but all my clients have had returns in double digits this year.
I can't tell.
This year.
We did.
And last year.
We did.
And the year before.
I had about 20% because it's a beginner, the luck of the beginner order this year. I don't know next year.
I have clients, and there are some here, who can tell you they had double digits every year in the last 5 years.
With all of the recession from
With
2008?
everything. Yes.
Okay, you are good with that.
You know,
Nicoletta, you know when it's the best time to invest?
When the market is down.
In the recession.
Really?
Yeah.
Absolutely.
Of course. If you have
you
the
know,
guts.
I just on that note,
Yes.
my son,
but your guts are not on your side. That's a problem.
It may be a problem, absolutely.
Yeah.
my son and I always tell this little story because my daughter says to me, her husband, when he was there one day, he said, "No, nobody in my office believes in an RRSP because they work in the government and they have good pensions." And I said to my daughter, I always invested it for her and encouraged her to invest. And I said, "Now look at your RRSP," and he has nothing. So I rest my case. I just rest my case.
Absolutely. If you have to pay the taxman when you take the money out, it's still money for you.
Yeah.
So you split it with the taxman because you didn't pay tax on it.
Yeah,
But
that's right.
it's not a reason not to do it.
Exactly.
Okay? So the next one is you can carry forward this contribution rule forever. Right? What is the weakness? You invest with after-tax money. You cannot deduct this money from taxes. Right?
You have to have a base in it, right?
You cannot recover tax losses. If you invest in a stock, and you invest in a stock in an investment account, which is not a registered account, it's just an investment account, and the investment doesn't work well and you lose money, you can carry forward that capital loss forever until you have a capital gain to offset it. So there is a way and a chance that you can recover that money. In TFSA, like the RRSP, you cannot do that. Which means that for you as an investor, the best is to be a little bit more conservative when you invest in RRSP and TFSA and take less risk than you take outside the TFSA and the RRSP. Okay?
Mm-hmm. Yeah.
Make sense?
Yes.
Yeah.
Okay. Tax-free gross for everything.
What do you mean about the weird rules on timing of the contributions?
That you cannot put in the same year.
Yeah.
If you took money out, you have to wait for the next calendar year.
Yeah, okay.
And it's not totally true, right? If you have $36,000, let's say you had $31,000 in the middle of last year, and you took out $3,000.
Yeah.
No, less than that,
Yeah.
right? If you have space for that contribution of that year, you can put it back, but it has to be calculated.
Yeah,
That's why I'm saying
that amount.
Yeah. Okay, and what's the threat? There is no threat, but it's the loss of a huge opportunity, huge opportunity. And we'll see why I say that. Okay? So, which one is better for me? That's the question. Now, the first criteria, which is what I call the rule of thumb, and rule of thumb are not always applicable for everybody. It has to be taking into consideration the personal circumstances of each person, which are always, the way I do the things. But the rule of thumb is, if you make less than $40,000 per year, you are better off to put money in TFSA. And the reason is that you are in a very low tax bracket. And if you put money in RRSP, for every dollar that you put in RRSP, you save, which means you get back and you defer only a very small part of the dollar, let's say 25%, 25 cents for every dollar. So every dollar that you put in RRSP when you are below $40,000 costs you 75 cents. Whereas if you are in a 50% tax bracket, for every dollar that you put, it costs you 50 cents, not 75 cents. So it's more advantageous when you are in a very low tax bracket to give priority to your investments in TFSA, which can grow tax-free and you can have all the flexibility in the world, rather than putting it in RRSP, even that you can take some money back or defer taxes. If you make more than $60,000 per year, then I say priority should be given to RRSP, because you already get back a significant portion of the $1, probably 45 cents, and it's worth your while to first contribute to RRSP and then contribute to TFSA. Okay? If you are between the two, if you are between 40 and 60, it's a matter of personal preference. There is no, it's a wash. It's more or less the same thing. So some people will prefer one over the other. Yes?
Sorry, Monica, are you talking about gross or net income before taxes, or when you say 60?
I say gross for taxes.
Yeah.
What's the marginal rate? So if you are over 75, 76, I think it's 40% tax, but under that, what is 30 or 20 something? I think
no, 35, 30, 25, there are more.
I think it's 15% to, I think it's
to $25,000. To 25,000. Yeah. Like the basic exemption is 11,000, and then you can make probably 25,000.
So between 30 and 75, it's how much?
46, and it goes in Ontario, it goes up to 49 now. With the new Ontario government, there is
49?
Yeah, 49.6.
This is progressive, right? Like
Yes,
up to
progressive,
40 you
yeah.
get the
Why did I
basic.
see 22 when I looked it up on the website?
You
It's
look
like,
right.
yeah, it's 22%, it's not bad, but it's not like it used to be, 30 and 40% years before.
No,
Because now we pay less.
I'm talking marginal tax rate, which is how it jumps with the different tiers, and you probably, maybe you are talking total tax, average. Yeah, and that's
What they
totally
tax
different.
on the income.
But because the average is made from this, usually you talk about marginal tax rate. So the marginal tax rate in Ontario, with the changes of the new government of Mrs. Wine, is 49.6%. It was changed from 46 to 49.6 by the imposition of a new super tax for the super rich. So if you have a business and you make $220,000 or more, you are taxed at 49.6%.
She's also trying to bring in a pension for the,
Yeah.
for the minimum wage earner.
So, if you have a child who is a youngster, 18, 19, 20, works, makes some money, what is better for him to put RRSP or TFSA? TFSA. And the RRSP contribution room will be carried forward and is better to be used later when he makes more money and he is taxed more highly, right? It's not lost.
Do you know if there's a higher tax rate on a RIF? Like, are you better off if you have?
No, the tax rates for RIF or RRSP, it's not based on where the money comes from. It's based on what level of income you reach.
I see. Okay. Thank you.
So it doesn't matter. So if you have a youngster who is 18, 20 and who doesn't work, can he or she have a TFSA, and how would you fund it?
You can have the TFSA.
They can have a TFSA and you can give them the money to do the TFSA.
But you don't have a right over it.
Pardon?
You don't have a right over it.
No.
You get not.
It's in his name.
It's in his name. If he decides to buy a car,
No, it's his.
you lost the money.
Absolutely, it's his, not yours. But if you have money and you have a youngster who is 18 or older, it makes sense to gift him this money and make it grow tax-free.
For a down payment. For a down payment.
For a down payment, for whatever, it doesn't matter, right? Okay, if you have somebody who is still working and he or she is 50, right? And they don't have much in RRSP and they don't have anything in TFSA, and they make $70,000 a year.
I would say RRSP. RRSP.
RRSP first, it's more than 60. Now, depending on their situation, there may be somebody who is expecting a big inheritance, right? Then maybe they don't need the RRSP and then it's the TFSA for sure. It's more flexible, right? And yes, Tatiana, it's only 5,500. There are rumors now which say that it may be increased to 10,000.
The TFSA.
Yeah, the TFSA per year. Yes.
I think it should have gone in this current budget that's coming, but they're not going to do it.
No, I didn't hear that it is, because obviously when they increase this TFSA contribution room, they give up tax. Right?
But they also look like the good guy because so few people.
Yes, but they give up tax, and if they have a problem of deficit, they don't want to do that. So probably that's not going to happen this year. Okay? Never, ever, ever, ever the money from TFSA is taxed. Never.
Because you pay the tax up front.
Always, 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 always the money that you take from RRSP or RIF is taxed. Okay? In non-registered accounts, just to fulfill the picture, right? Does it matter how you invest the money from the point of view of how much tax you pay and how much money you keep in your pocket after you pay the tax?
What do you mean by that question?
Non-registered.
And non-registered accounts, not in RRSP. Does it matter how you invest the money in what?
Yes.
Yes. Yes. Okay, TB.
So if you invest in fixed income,
yes,
GIC, stuff like that, then your tax, the interest becomes each added to your taxable income.
Yes.
You invest it in a stock.
Yes. Yes.
You can make a lot of money or just gone with the wind, but you your monies are taxed. If you gain, the income is taxed favorably. Yeah, it's like you pay less tax than it's not directly added. It's
okay. So thank you, TB. You're right. There are three major ways of taxing the money that grows in investments. One is the most tax is paid, so the tax is paid in full on the growth of the money which is considered interest. The money that is considered interest is generated by GICs and by bonds of any kinds. So the Canada Saving Bonds, the premium bonds, the real bonds, the government bonds, the municipal, provincial government bonds, the corporate bonds, anything that is paying interest is taxed at the max.
So everybody's taxed at 50%, or
no? Everybody, that money is added to your income
and
on top of
your
it,
taxes,
and you pay marginal tax rate.
Right, whatever applies to your income.
Whatever applies to your income. Yeah. So if you have no income, you are a person who has no income, and you have investments only in GICs and bonds, and they make you $11,000 a year.
Yeah.
That's the basic credit that you have, you pay no tax.
I see.
Okay? But if you make 20,000, you will pay tax as on 20 plus 11, 31, you will pay tax on 31,000. So the interest is taxed at your marginal tax rate at the top.
Yeah.
Okay? If you make your money by investing in a stock, and the stock value has doubled, okay? It cost $100, now it costs $200, and you sell the stock. So you paid $100, now you get $200 because you sold it. So you have a growth of $100, okay? That's considered capital gain. The capital gain rule of taxation in Canada today is only 50% of it is taxed.
$50.
So you will pay tax on $50 from the $100 that you made. Okay? And this $50 will be taxed at your marginal tax rate. It will be added to your income and taxed at your marginal tax rate. But this is the asset class, that's how it's called, which is taxed the least. Okay? And in between the two, there is a rule of taxation for dividends. So you buy a stock, and that stock is TransCanada Pipelines, TransCanada Corporation. And you pay $100 for the share, and they pay you a dividend because they want to reward you for the fact that you are holding their stock. So they pay you 4% per year, $4, okay?
On $100, yeah.
On $100. There is a rule that I don't want to confuse the hell out of you, but there is a rule that professional accountants and financial advisors know, which gives the dividend a tax credit. And
credit.
It favors the taxation of the dividend, and it's as if it's somewhere in between the interest, which is taxed 100%, and the capital gains, which is taxed 50%. It's somewhere at 65% taxed. So not on the full amount, not on half of it, on a little more than half. Yes. So the most tax efficient way to make money in a non-registered account is to have stocks, right? Because if they grow, you pay the least tax on the growth, right?
But if they go down?
The most inefficient way is to be in GICs and bonds. Okay? And the one in between is to be in stocks that pay a dividend.
The higher tax rate.
Okay?
Yeah.
Yes, TB.
100% tax.
One more thing about the stock investment, which is it's always nice if the market goes up, but sometimes it goes down. So let's say our $100 investment in stocks, it's worth now $50. From the tax point of view, that's also taxed favorably, because I think it's a capital loss, and you're allowed to carry that over, if not reduce your taxable income with the loss in that current year.
No, you cannot reduce the taxable income, but you can offset that in the future. So let's say you invested 100, the value is 50, you need money. Because you need money, you need to sell it, right? You have to sell it, you get 50. You paid 100, you get 50, you lost 50, okay? This 50 is called capital loss. And you are allowed to carry this forward forever until such time that you have a capital gain of 50, which will offset the capital loss. So when you'll have a capital gain of 50, you will put it against this capital loss of 50 and you'll pay no tax. Okay, so you can recover some of the losses in non-registered accounts. Now, I did this detour because I wanted to talk and ask you, does it matter in what you invest your money in RRSP and RIF from the taxation point of view?
No, I don't think so.
So no?
I have no idea.
Maybe from the RIF.
RRSP and RIF from taxation point of view.
Does it matter in what you are invested in the accounts? From the tax efficiency point of view.
That is not good
from a
in
taxation
stocks
point of
for
view,
those, and it's good for stocks when you are in non-registered. So for RRSP and these are more conservative.
Okay, but does it matter from the taxation point of view?
Okay, sorry.
Would you be safer in an RRSP?
You want to be safer, but I'm not talking about safety right now. I'm talking about the taxation point of view.
If you're investing,
Tatiana?
RRSP.
It matters.
It does?
Yeah.
Okay, why?
I cannot tell you.
Okay.
You're saying no?
I don't think.
Penny, yes?
Because you're deferring your taxes till later, it might matter.
You defer your taxes no matter what, because you put the money in.
Don't you invest? Don't one of those funds invest?
1 second. Anybody?
Depends if it makes more money.
Adrian.
Which ones make more money?
Yeah, but from the taxation point of view, does it matter how you make this money grow?
In an RRSP or
in an RRSP or in a RIF? Yes.
I don't think so.
No. Does it matter, TB?
No.
Does it matter? Does it matter? It does not matter, because no matter how you make your money in RRSP, when you take it out, it's taxed as if it is interest.
Yeah, it's part of your income.
It's taxed as if it is interest. It doesn't matter how you make it.
You're right.
So you're
It
saying.
doesn't matter. That's the rule.
So when you take
because the money that you have in RRSP is money before tax. So when you take it out, the taxman is your best friend. And it will consider that money, no matter how it was made, it will consider that money interest and tax it at the max.
Like a bond or like
a bond or a GIC.
GIC.
That's
So
right.
it doesn't matter what you invest in.
Okay?
You lost me.
I lost you? Okay. I just don't want to keep you until 10 and a half, until midnight.
Okay. Yeah.
We'll take this separately if you don't mind. Okay. So, always when you work with a professional, if it's a good professional, he or she will keep this in mind. will take this into account. And it's very important to keep this in mind and take this into account. It's almost as important or more important than how the person will choose your investments. Okay? So we finished this. Planning strategies. Planning strategies has to do with the fact that you plan for different situations. You may be somebody who is planning for the guaranteed income for life. They want to have a guaranteed income for life. They want to keep their lifestyle the same. The most difficult thing for anybody after the death of a partner is changing your lifestyle. And immigrants know that for sure better than others. There are tools which will help do this planning of guaranteed income for life. There are segregated funds and there are annuities. These two types of investments will guarantee either the capital or the income that you can get. And again, these are not for the people who have no knowledge. That's why you should use a professional to discuss these matters. Now, there may be people, having situations in which they will get CPP, they will get OAS, and they have a big RRSP, and maybe they have a little bit of a pension from the workplace. Now, is CPP taxable?
Yes.
Yes. Is OAS taxable?
Yes.
Yes. Is the pension taxable?
Yes.
Is the money from RRSP taxable?
Yes.
Okay. So what happens with that person when they get to retirement? Everything that they get is taxable. How much tax will they pay? Normally, you consider, or it's the rule of thumb to consider that when you are in retirement, you will pay a lower tax. But if all your sources of income in retirement come from places which are taxable, you have almost no recourse to save on your taxes.
Yeah, because you have no write-off either, really.
You have no write-off. Unless you are a business and you continue to work, then you may have business expenses, but then you have also business income.
So are there ways of creating non-taxable sources of income?
That's when it makes sense working with a professional to plan for what is called an RRSP meltdown.
RRSP what?
Meltdown.
Meltdown, yeah.
So, an RRSP meltdown means take advantage of an opportunity to take money out of the RRSP in a way in which you can minimize the tax and build a reserve that will be not taxable, like a TFSA, for example.
Planning for guaranteed
right?
for like
Or an investment account,
funds.
which is much less taxable, because in an investment account, if you have $100,000 invested in stocks, all the growth that you will have there will be capital gains, which is taxed the least.
See, that's what I'm understanding of why you wouldn't put that money in. I get that you're doing the tax savings, but why you don't put that in that TFSA account?
No, I said TFSA. I said you melt it down and you put in TFSA. That's the best use. But maybe you need to melt down more than 36,500, which is the maximum you can put in TFSA today. You cannot put 100,000. You're not allowed.
But if you're putting that in there today and you're taxed, when you retire, you're not taxed on that at that point.
That's
you're
right.
Taxed on your
That's
RRSP,
right.
that you're not taxed
That's
on.
right.
That's right.
So it really balances itself out, no? Kind of, sort of.
It not balances out, it's saving you taxes. Because, let's say somebody is 65 and works with a professional, and they decide that somebody will have CPP, OAS, pension and RRSP, all these are taxable. But the person is going to not use the RRSP as a REEF until the age of 72, okay? So there are 7 years in which the income will be only CPP, the pension, and the OAS, which may not be very high. That creates an opportunity to take money out of the RRSP and pay a low tax and build a tax-free or a better tax environment of investment for later on, instead of leaving the RRSP to be humongous and all the money will be taxable.
Right. Okay, got it.
Okay?
So are you saying that you should leave space, in your TFSA account as you're coming up to that point?
If you have already filled your TFSA, then just do an investment account. It's still better than leaving the money in the RRSP.
You can take it out and put it in.
You can take the TFSA out as is. It's your money, it's already taxed. Put it in, I don't know where, in Bahamas. And then next you replenish the TFSA with the extra money that you save from the RRSP. But I have a question here. Do they still allow you to melt down your RRSP to buy your first residence?
I told you that if you didn't have a residence for 5 years.
So if you sell it at 60, you sell your principal residence, you live for 5 years on rent, in a rental property, and then you melt down whatever portion.
You take 25,000.
25,000.
Yes, you can do that.
Can I just ask
if the bank will give you approval for the mortgage to go on, because if you are at 65.
Yeah, but you got rid of your principal residence, which means.
Let's take this offline.
That's off. Okay.
I just have a question which is actually relevant, because my husband is now going to retire, and he will have Canada pension, a work pension, old age security, and he does have RRSPs. So he also has room in his RRSPs. So this year his income will be higher because he'll get retroactive RRSP payment. So I'm wondering, is it more advantage for him to put a lot of money, like I'm saying, like a few thousand, into the RRSP, or should he wait until he has that RIF that he has to take?
Okay, I forgot your name.
Nolene.
Nolene, the answer to that question cannot be an answer that I give you. It has to be calculated. If you book me for a consultation, we can do this calculation, no problem. But I have to see the numbers and run the numbers in order to be able to answer. Otherwise, it would not be, professional for me to tell you. But I am just describing the situation when it may make sense, right? Okay. In general, it makes sense to plan your retirement income, because even that it's only a plan and the things are what if, it will give you much more a feeling of security and peace of mind if you know it, if you look at it with your eyes wide open instead of the eyes closed. Okay? And most of the people do not look at that, and that's a mistake. You can plan for the child education using the RESP, which again is not something that people understand very well, or using the TFSA. And you can plan for transferring wealth if you have enough and you want to transfer this to the next generation.
Without being taxed.
With being taxed the minimum. Planning will save you tax. Not planning guaranteed will make you pay more tax than if you planned. That's very, very important. So cash flow in retirement is very important. There are strategies to plan for that. these are some examples of things that can be used in order to create this cash flow and to have it monthly. I don't want to spend too much time here. Now, ruling means mastering, means controlling. And I think one of the things that makes people fearful, anxious, and uneasy is if they don't control their destiny. That's the most discomfort creation possible. So if you start your withdrawals, that doesn't mean that the other investments that you have in the either RRSP or RIF have to stop making money and growing. They don't have to stop. You start, even when you convert the RRSP into a RIF and you start withdrawing money from the RIF, you should still want the investments to grow, and if possible to grow at the value, at the rate of withdrawal that you use.
At least 4% is what you're saying.
When you are at the age of 72, the withdrawal rate is 7.38.
Oh, it's 72. It's 7.38.
7.38% of the value of your RIF portfolio on the 31st of December of the year before.
Yeah, 7.38% is what you have to take out when you're 72, 1 or whatever.
So that means
72.
you deplete quite easily.
Well, it's always a percentage of the value, of the market value on the last day of the year before. So in principle, it's never going to be depleted.
If you make 7% back from other,
it will
continues growing.
Yeah, the capital will be depleted because this percentage will grow. Every year, every age has a higher percentage. And if your capital, which is invested, doesn't grow at the same level, then at a certain point in time, there will be erosion. And I think at the age of 85 or something like that, the percentage is 20%. So you normally cannot make a portfolio grow by 20% per year. It's very, very hard, especially if it's in a RIF. You want to be safe, so you're not taking so much risk, etc., etc. So there is a normal depletion, erosion of the capital in a registered account. But it depends how it is invested, because, for example, let's take a RIF, and these are real examples. I had a client, and that was 10 years ago or maybe 12 years ago, and she had, I don't know, 150,000 in her RIF, and she was extremely unhappy because every year she was getting another amount of money. First of all, the percentage changes. Second of all, the market value at the end of the year changes. And pretty soon after you start, 4 or 5 years into it, the capital is eroded, and even that the percentage goes up, actually the amount of money that you get decreases. Because the base is shrinking, right? So she wanted to have all the time the same amount. So we did an annuity. We bought an annuity for her. The rate of return of that annuity at that time was about, I think, 9%. So that fixed that she took the $150,000. An annuity is a life insurance product. It's a product of an insurance company. I am licensed for both securities and insurance, so I'm licensed as an insurance agent. And we bought an annuity. We put $150,000, and she had 9-point-something% of that $150,000 for the rest of her life. Never changed.
What if the insurance company goes bankrupt? Remember
There is a Crown Corporation which insures the insurance company. It's never happened in Canada since Canada exists that any person owed money by an insurance company didn't get it. ever.
CDIC covers that.
No, CDIC is for the banks, but there is something similar. It's called a series.
So it's annuities, just to understand what you said about the annuities, so does that mean if you take out an annuity and you live 1 year, you lose because your money is gone, you lose the capital?
That's a very good question, Noreen. It depends on the type of annuity. Okay? 12 years ago, that was true, and even then it was not totally true because you could, and I think that's what we did. I bought an annuity with a guarantee, and the guarantee of 10 years or more guarantees that the money will be paid back, the money that was invested will be paid back. If she dies after a year, it will be paid back to her beneficiary for the other 9 years. Okay? But if she lives 25 years, she is paid the same thing for 25 years, which will be much more than the 150,000 that she initially put in.
Can you put somebody else on your annuity with you?
In which way?
So that if something happens to you, they continue to get it?
No, because you put your grandchild.
Yes, you can. Yes, you can. No, yes, you can. You can put
big box.
It's called a successor annuitant. Yes. So the variations of these annuities is extremely big and bigger now than ever. And I like these things for senior people and for people who are risk averse, because it allows them to have the security of a fixed amount of money that they will get forever.
And the successor annuitant then would be whatever they would get then wouldn't form part of your estate really in terms of estate tax.
No, if there is a successor annuitant, it doesn't go to the estate.
So is 9% a typical rate of return for an annuity?
Well.
No, the rate of return for an annuity depends on your age and when you do it, right? Now, if you are 50 and you want to do an annuity, it will pay you so little that it's not worth doing. But if you are 75, I don't know. If you are 80, probably it's worth doing, right? It depends. And in low interest rates environment like now, the returns will be less than if the rates will start going up in another 6 months. And in another 2 years, they will be with 2% higher, let's say. It will be absolutely a consideration to do annuities. For people over 75, I will do a quote and look at what the rate of return would be. You don't need to do it to find out that information. Okay?
Monica, what do you think? This might be a little bit aside from this, but some people talk about doing a reverse mortgage. Do you think that's a good idea or not? No.
I am one of those financial advisors who is strongly against reverse mortgage. And I'm strongly against reverse mortgage because in a reverse mortgage you lose control of your property. However, there is another way in which you can use the equity that you have built in your residence if it's fully paid. You just set up a line of credit, which is secured by your residence. And that's something that I look at and advise my clients to look at as an emergency fund to be used only in huge emergencies, which doesn't cost you any money.
If you don't use it,
If you don't use it, or very little money. When you set it up, it costs you a few $100. But it's something that you can use if there is a life-threatening situation. It may be better to be used than to sell your investments to use for that particular situation. And it will be covered when the property is sold.
Yes.
Because it's secured by the property. And I like to have access to emergency funds without having to keep cash as cash for emergency. I like that. I like to create situation for my clients in which they can get an emergency fund and they don't keep cash for that emergency. Because cash doesn't make money.
No, you're right.
Right? So it's my personal
Yeah,
preference.
annuity are affected by inflation, or it's a fixed amount?
No, you can set up an annuity which protects you from inflation, which will will increase the payment by 1% per year.
Yes.
Whatever.
Okay.
Now, when you convert your RRSP to REEF, you don't have to take all your money out or get out of your investments. It's just a name on the door which is changed, and the fact that you have to take out a certain amount of money per year, which is a minimum amount, that's a mandatory thing of the REEF. But, of course, there is flexibility, and you can I had clients who were, let's say, 60 and would retire because they had enough income coming to them, but they missed, I don't know, $5,000 per year to keep their lifestyle. So we took the RRSP, we opened the REEF, and we moved from the RRSP into the REEF enough money to generate that $5,000. So the minimum mandatory was $5,000, was complementing what they needed, and the rest was in RRSP, didn't have to be taken out, could continue to grow, and if they work, they even could continue to contribute and deduct that from their earned income. Right?
So when do you have the advantage of, so say you had 30,000 room in your TFSA by the time you had to take out a RIF.
Mm-hmm.
So you're mandated to take out 7.3%. So if you put 30,000 of that into the TFSA account, when does that really become a gain for you tax? Because
no, it will be taxed for you to take it from the REEF.
Yeah,
and put it in the TFSA, you first pay tax.
But the following year...
But then what you put in TFSA will grow tax-free and will never be taxed. I have an example in a moment, we'll get to an example, okay? So that's very important. Now, what will impact your cash flow from RRSP or REEF are two factors, right? The rate of growth and the rate of the withdrawal, right? These are the two factors. And it's very important to plan more or less how this will be when you do work with a professional and you plan your retirement income, okay? Now, how much money you keep in your pocket is impacted by your marginal tax rate and by the tax efficiency of your sources in income in non-registered account. So you may be making the same amount of money if your non-registered account income is not structured properly for tax efficiency. Less money will stay in your pocket and more money will go to the taxman. And nobody else is guilty of that than the fact that you didn't work with a professional. Of course, from all the asset classes, the best growth is in equities, and I wanted to bring here a chart which would show that, but you can believe me, that stocks are the way to grow, and even for my senior clients who are over 70 and 75, I keep a large amount of their investments in equities if their risk tolerance is sufficient or if they understand what I'm telling them, because you want this money to grow as much as possible because the rate of withdrawal is growing. Okay? What you don't know may hurt you, because if you don't know all these intricacies, you cannot use them and you cannot make your situation the most tax efficient.
I have a really good example just there many years ago, like now I'm much more enlightened, but when I was much younger, I had Canada Savings Bonds. We had saved quite a bit of the Canada Savings Bonds for a house or something. So at that time, now if you have them in, even if you put a 5-year GIC, they will give you the tax, they'll tell you how much you owe in tax each year, but at that time they didn't. So I think I had it in for about 10 years and we took it all out at the same time. And we owed a huge amount of tax that year. I learned from that. I've come a long way since then, but that's just to capitalize on what you're just saying.
Yeah.
That's exactly.
Now, I have an example here about a situation
Do we have that here?
for somebody who, let's say, needs to melt down their RRSP. So I worked these numbers just to show you, to give you a feeling about what's happening. So first of all, that's somebody who is 700,000, 70 years old, has $300,000 in a RIF. It's invested and it returns 5.5% per year. I am very conservative and has to withdraw at the beginning of the year at the level of 5%. Okay? Now, of course, you can decide that you withdraw your money from the RIF and you want this withdrawal to happen monthly, not in one shot at the beginning of the year. But you may want it at one shot at the beginning of the year, or you may want it in one shot at the end of the year. Mm-hmm. Now, which way will be the best from the point of view of the growth of the money in the RRSP? Beginning of the year, end of the year, or monthly?
End of the year.
I think, I don't know, monthly you can reinvest it along the way.
It does matter, and it's end of the year. Because you let the money grow for another 1 year in a tax-free environment.
Oh, I thought you were talking after you took it out.
No, when it's the best to take it out if you want it to grow the most.
Oh.
In one shot at the end of the year.
You're not talking about what you have to take out.
Yeah, I'm talking about what you have to take out. So the only rule is, Nolene, that you have to take it out in that calendar year. But you can take it out on the 25th of December.
Oh, I see. Okay, yeah.
So why is that money not put on for the full year?
If you take it out on the 5th of January,
right,
the whole year, you have the money out, you spend it. It's not in the sheltered from tax environment to grow.
But you have to be able to sustain yourself on whatever income for the year.
Right.
This is where visa comes in handy.
Right.
But I thought when you take it out, you're not taxed on it. Like
no, you taxed on it next year, but it doesn't matter. You will be taxed on it. But if you take $10,000 at the beginning of the year and your investments grow by 10%, at the end of the year, these 10,000 would be 11,000. You take the 10,000, you leave 1,000 in.
Okay, got it.
But you don't have this 1,000 if you take it at the beginning of the year, right? So it's different. And of course, if you take it monthly, it's in between, right? So these are really the numbers. This is how much would be in the account if the withdrawal is at 5% at the beginning of the year, and I assumed that the growth is 5.5%, right? Mm-hmm. So the capital, based on which the calculation of the next year, these are real numbers, and you have this in the handouts that I've given you. Mm-hmm. These are the percentages, and they apply to the amount that is in the account at the end of the year, right? Mm-hmm. And then the growth is applied at the amount that is in the account at the beginning of the year, because here it's assumed that you take the money on the 5th of January, and then the rest of the money grows, right?
Yeah.
So at the age of 83, this is how much money would be after the last time, okay? So it's depleting, that's what I'm showing.
I know.
Now, you have quite serious money in the TFSA. You can afford something that you couldn't afford otherwise, or if you spent all the money and didn't use the TFSA, that's what it is, right? So, was it valuable to spend the time here this evening?
I think it was excellent. I thought you did a great job.
Thank you. I'm not yet finished. I have to tell you how is it that I am making a living. I am making a living because I work with people like you and you are paying me. Now, do I deserve to be paid for what I'm doing? I usually get up at 6 o'clock in the morning and I usually get home at 10 o'clock in the evening. And what do I get? I get paid either commission or fee or trailers. Now, commission I get paid if we do trades in an account.
Stock market, are you talking about?
Stock market.
Like it has to be a stock.
It has to be a stock or a bond. It has to be a security.
Mutual fund?
Mutual fund is different, and I will tell you in a moment how it's mutual fund. So, for a stock or a bond that is bought on the stock exchange and sold on the stock exchange, I am paid commission. This commission may be, for stocks, the rule of thumb is 2% of the amount of money that we use, but there is a minimum commission of $135, okay? For mutual funds, I am paid in two moments. There is a payment when you buy the mutual fund, and there is a payment while you are owning this mutual fund. When you buy the mutual fund, the payment will be different depending if the mutual fund is a front-end mutual fund, back-end mutual fund, or a low-load mutual fund. Front-end mutual fund, the commission will be normally between 0 and 5%. So let's say $10,000 invested, the front end invested in front-end mutual fund, the payment will be between 0 and $500. Now this payment doesn't come to me straight, it goes to the company that I am working for or under the name of, even when I am independent, and then it's split between the company and myself. But let's say this is what it costs you to use me. Now, for back-end mutual fund, the mutual fund company will pay the $500, but you have implicitly agreed to keep your money invested with that mutual fund company for up to 7 years. You can take out 10% of the amount of money every calendar year. So for $10,000, you can take $1,000 every calendar year, costs you nothing. But if you want to take out 20%, let's say $2,000, they say we planned that the majority of this money will be with us and will be invested for 7 years. So if you take it after 2 years, we didn't plan for this amount of money. So we need to be compensated that you messed up our plan. And there is a redemption fee, a sort of a penalty for redeeming more than 10% in a calendar year. And the longer you are with the money in that mutual fund company, the less the percentage of the penalty. After 7 years, there is no penalty. If you want to move from that mutual fund into another mutual fund, which is in the same mutual fund company, with another manager, with another characteristics, another objective, that move can be made, and I don't charge anything for these changes, for the switches. There are advisors who will charge between 0 and 2%. Okay? For a low load, again, you pay nothing, the mutual fund company pays me for the purchase, doesn't pay me 5%, pays me 2.5%. I don't remember. It depends on the company. And you have the obligation, implicitly agreed, to keep the money there for 3 years. Okay? So not 7, it's 3, it's more manageable. For the front end, I never charge 5%. I always discount the 5% to 3.5%. So if you invest $10,000 and we decide to put it in front end, I will charge you 3.5%, that's $350. $9,650 will be invested, $350 will be used to pay me and my
There's
company.
no other payment after that? You're only subject to keeping it in as long as
Okay,
you want?
so, Nolin, every year that you stay in that mutual fund, the mutual fund manager has to be paid. The administration of the big amount of paperwork has to be paid. There is a form of payment in any mutual fund which is called MER. MER stands for Management Expense Ratio. Usually in Canada, a normal equity mutual fund will have a MER of 2.3%. That's the average in Canada, 2.3%. From this 2.3%, I am paid between 0.25% up to 1%, depending on the type of mutual fund, back-end, front-end, equity, mixed, balanced, etc., etc. So from this 2.3%, 0.25 to 1% may be paid to me as a trailer. Okay? So you have $10,000. In the second year, it may cost you $230.
And in the first year, you said it would cost you?
The purchase fee. So there is purchase fee, and then there is MER. The MER is an annual expense. It's normally taken from the pool of money before the profits are distributed. So if I tell you this mutual fund has returned 5%, in fact, the mutual fund has returned 7.3%. Because I will tell you that the return is after net of cost, of every cost. And in that cost, there is a trailer fee included that I get.
So for us, anything that you tell us we made, that's what we've made.
That's what you made, exactly so. Exactly so. And there are some rules and regulations new which are coming into being, and the statements will change starting in July this year. And you will get statements in which it's written how much money I have made from your investments.
Oh, really?
And you have never seen that before.
No.
But I always talk to my clients and explain all these things, but many other people don't. So now they impose this as a regulatory.
That's for everybody.
Wow, for
that's
everybody.
Interesting, yeah.
Yes. So it's called CRM2, and it's coming. Everybody is working like crazy to change the software which is producing the statements to implement this CRM2.
Do you know what was an interesting thing they used to have on my statement? They'd say how much your portfolio was worth last month and now this month, but it doesn't do that anymore.
No, because they don't want you to know.
Yeah.
Because they're not so happy with what is happening, and instead of you knowing and being able to call and ask a question, they just don't put the information there.
It's not just me.
It's not just you. It's most of the places, and I am an engineer by background, and an engineer is always an engineer, so I don't work this way. I will always look at how much money was invested, how exactly was the return. Is it including that? Including that, there is no such a thing with my clients. It's always very clear. Is it, Adi?
Yes, it is.
Okay. So these are my payments.
Okay.
What do I have to do to earn this money? Okay. I have to talk to people who are not my clients, right? I have to prospect. Have to convince them to start working with me. Is this prospecting activity paid? No.
It might be in the future though, but you never know.
No, it will never be paid.
Oh, no, but I mean, you may get clients.
The new
from it,
clients
yeah.
and stuff.
Yes, but you know, the time that I spend to do the prospecting is not paid.
That's right.
And it's the majority, or should be the majority of my time. I have to talk to my clients, right? With the prospects, with the suppliers, which are the wholesalers of different mutual funds, of different products, with the regulators. I have to do paperwork. Are these things paid? No. I have to keep up with the market. I have to know what's going on, right? I have to learn new products if they come out, products from insurance, for example. I have to be up to date with the regulations. Is this time paid? This work paid? I have to prepare proposals. Now, some of you are or have been my clients and some of you have not. I will always have a proposal, and I will have also another option and another option for the case that you don't like something in my proposal and you have another preference. These proposals, I work hours and hours to make them, to do my due diligence and research. This is not paid, right? I have to do presentations like today, have to prepare for this presentation. I have to do marketing for my business. All this is not paid. And if I take vacation, I don't make money. I have no salary. I am only paid either commission or fee. Now let me talk about the fee. There is today another way of setting up the accounts in which instead of paying commission for every trade, you pay a fee, which is a flat fee, based on the amount of money that you have in that portfolio that you invest with me. And that fee is usually less than what the commission that you would pay if we do normal individual trades, because the market today is extremely volatile. And there is a need to change the investments much more than it was 15 years ago, for example, when I started.
So what is the percentage?
The percentage is, there is a grid. So I think up to 250,000, it's 1.75. Between 250 and 500,000, it's 1.5. Between 500,000 and what's the next step?
750, I believe.
750, it's 125, and then it goes to 1. And if you have more than $1 million, it will be less than 1%.
Do you offer fee for services?
No, yes and no, okay? Yes and no. This is fee for service. This fee-based account is fee for service. There is another way of offering fee for service. I can do a financial plan and charge for it, which I couldn't do that in other places where I worked before. I didn't really start doing that, but in principle
So if somebody would come to you with a portfolio and with a time horizon, and ask for advice, what would you charge for a service like that?
I cannot answer, but it would be an amount that we would talk, and if we agree, then I would do that.
So this would be an annual fee. Is there another fee that may
No
be like
other fees.
charges?
All the trades would be done with no fee, and there are some very significant benefits in using the fee-based account rather than the trade-based account. One of the benefits is there is a special type of mutual fund which is called Series F from fee, and the Series F have a MER which is by 1% lower than the normal MER. So the normal mutual fund will charge 2.3% for the MER. The F series will charge 1.3% for the MER.
You still have to pay charges if you're on fee-based?
No.
Yes, well, they have
still
to
pay on the trades too?
No charges on the trades.
But to you, but to the companies?
No charges on the trade. It's only the fee. The fee is everything, covers everything. And then another benefit is if we do stocks, I use usually a strategy which is called stop loss, and I put in the computer an order which says, the strategy works like this. Let's say I bought a stock and the cost of one share was $100. Mm-hmm. And the market is volatile and the value of that share changes every day, every moment of the day. And I am saying as long as the fluctuation of that share value is above $90, I am fine. That's normal fluctuation of the market. Mm-hmm. So I will put an initial stop loss at 10% below the price that we bought. So at $90, I say in the computer, if it gets to below $90, sell. Sell and protect 90% of my capital. Okay? Now, 2 months went by. This was a good investment. The price changed from 100 to 110. Okay? I am reviewing this every 2 months. I see the price moved to 110. I change the stop loss to 100. Okay? Another 2 months. Now it is 120. I change the stop loss to 110. So I have the possibility to protect not only the capital, but also the profits which were already made. Okay? There is a lot of work to do that because you may have, 15 stocks in one account and you may have 7 accounts. And some people may be very active. Mm-hmm. But it works and it really, really protects the capital. Can you share a little bit of your experience, Adi?
Well, I've been with Monica for now quite a few years. Now, the active word was to me.
The what?
She said some of my clients are very active.
Oh, okay.
And that was me in mind. Mm. So there are times that I review things with Monica fairly often. So it is extremely important that the way she works with me protects my investments tremendously. Because it's not just a matter of stop losses, it's how the market moves, you react with that, and it takes a lot of her time. To give you an example, if I should sit down with Monica to really review my portfolio with her, I will be with her on the phone over an hour. And I will get more than an hour without any interruption. And at no point in time will I be given that impression that I need to hang up now. So there is work, but that's what it is when you do investments. It's a pretty proactive thing. And it does take a lot of her time, which she gives you. And it has its definite benefits.
And not everybody is very, very active like Adi is.
Then it needs
I have other clients who have fee-based accounts. And maybe we review once a month, maybe we review once every 2 months, maybe we review it once every 3 months or 4 months. But I can use the stop losses, which I can use even if the account is not fee-based, but if the account is not fee-based and I use a stop loss and something triggers that stop loss, there will be a commission paid.
Mm-hmm. Yeah.
Because we sold the investment. There will be another commission to be paid to reinvest that money. Therefore, I am much more concerned and reluctant to use the stop loss strategy with accounts which are not fee-based. And there is something...
You might want to crunch that with numbers.
Yes.
Then you might be able to get a better picture
Yes.
of what you say.
Yes.
I think when you take the value of the investment to the commission that you'll end up
Yes,
paying
and
on
it
the
depends
trade,
on the personality, etc.
Exactly.
There is no rule carved in stone. But it makes sense for some people, and for some people it makes sense to be trade-based, and that's fine with me no matter what happens. And I hold you for a long time. So, was it any value for you to attend today's seminar? Was it educational?
Yeah.
Is there information you can use immediately?
Yeah.
You can make better decisions that will impact your life for a long time. You can get to know a person who may be your sounding wall for some decisions which are important, right? And what you do know may hurt you. It's very important to work with a professional. So if you are new to investing, start with an initial consultation. If you are not totally satisfied with what you have right now, ask for a second opinion. If you have not started anything, just do it. We are very proud, and I have to thank Monica, who has put a lot of work.
We work together, Monica. That's nice.
We have a new website, which is called Wealth Management MW from Monica Weissman.ca, and you can go there. We are putting there articles that I'm printing, and I advertise different events that I'm going to do, and you have that in your little folder. These are the details of my coordinates and Monica's with the K coordinates. And we thank you very much for being here. And we have a little survey that we would be very, very happy if you can fill it.
Yeah, okay. It says you put your name down.
And one of the things on that survey, the page on